Professor John Cochrane, welcome to Miami.
It's a pleasure to be here.
You're here for a conference on monetary fiscal policy interactions. We're very pleased that you were able to join us, and you'll be giving a talk later tonight, public lecture on inflation. Now, you've recently published, a book on the euro, but just prior to that, you published a book on the fiscal theory of the price level. Very popular book. I've got 2 copies myself. I hope you'll sign one later. It's a theory that's like people are talking more and more about in the profession, and I see it actually being discussed a little bit in the popular pages of the newspapers. Can you tell us in very, very plain language, what is the fiscal theory of the price level?
It answers the fundamental question, where does inflation come from, really, in the end? And its answer is more government debt than people expect the government to be able to or to be willing to repay by future taxes in excess of spending. And that's crucial. It's not just debt and deficits are bad. It's debt and deficits are bad when people don't trust the government to pay them back again.
That sounds like common sense to a lot of people. And I think that indeed, if I recall, Milton Friedman probably would not have disagreed with what you just said. Milton Friedman is famous for his dictum that inflation is always and everywhere a monetary phenomenon. Where does the fiscal theory agree or disagree with that interpretation, and kind of why does it matter?
There's a lot of agreement, but a little bit of disagreement. The fiscal theory, fundamentally, we look at government debt like stock in the government. So if you don't trust that a stock is going to pay back dividends, you try to get rid of it, that sends the price down. If we don't trust that the government will pay back its debts, we try to get rid of it, and we drive the price of everything up. That's the simple idea. Friedman focused on the quantity of money.
Yes.
And he noticed that governments, when they print up money to pay their deficits, give rise to inflation. Well, money is just another form of government debt. So we entirely agree. If you dump money or dump government debt on people, they're going to try to spend it. That sends up inflation. Where I would disagree, and where fiscal theory disagrees with Friedman, is if the government gives you money but takes back government debt. So I give you $20 bills and take back 2 5s and a 10. Does that cause inflation? And a monetarist would say yes. Giving you the money and taking back the debt causes inflation. A fiscal theorist would say that's kind of a wash.
So that's exactly the operation you just described is quantitative easing. And I guess one of the implications you're saying is that the fiscal theory says there's likely to be very little inflationary consequences from a quantitative easing or large-scale asset purchase by the Fed. The monetarists would largely disagree with that.
Yes. Well, almost. I'll give you the asterisk.
Okay.
I think the last couple of years have given us the most beautiful experiment we could want to distinguish fiscal theory from monetarism. In COVID and afterwards, our government gave people about $5 trillion of money in debt. What do we get? Inflation. Yay, fiscal theory. Under quantitative easing, they gave people money and took back the debt.
Right.
A monetarist predicts that has exactly the same effect.
Right.
And it was about $5 trillion in both cases. Fiscal theory says, no, the exchange has no effect. Giving people stuff, big inflation. Guess what? It came out exactly that way. All that QE, trillions of dollars of quantitative easing, should have led to Zimbabwean hyperinflation. What happened? Nothing.
What do you think, though? I know that argument, but I mean, the two situations were very different in terms of the forces that generated the shocks. I mean, Milton Friedman might say something, well, the financial crisis was a collapse in the private money supply as a highly deflationary shock, whereas the COVID shock was, basically a supply side disruption. So it's not really it's not quite the clean experiment you're describing, but
I think the magnitude of it makes it a lot cleaner.
Okay.
Bank reserves used to be about $10 billion. Under QE, they expanded to $3,000 billion.
Yes.
The magnitude of the shock makes it harder to wheedle your way out of it.
Got it. So listen, after the financial crisis, the United States and many other countries became accustomed to relatively low inflation, and then suddenly the United States and other countries have experienced this surge in inflation. The cost of living has increased dramatically and remained high. The inflation rate has come down somewhat. The interpretation then from the fiscal theory is what? It was fiscal, but are there policy implications associated?
Huge.
Yes.
So this episode, and that's the talk I'm going to give tonight, this episode just fits fiscal theory of the price level to a T, and not the other theories. We dumped $5 trillion of new money in government debt on people. They went out and tried to spend it, drove up prices. The price level went up. But once that was done, it was a one-time gift. Once that was done, the price level stays higher, but the inflation rate doesn't stay higher anymore. Whereas most theories say you have to have the Fed coming in and raising interest rates in a recession and all that. None of that sort of thing happened. So yes, that's what happened. That's why inflation came. That's why inflation went away. Yay for fiscal theory. I think the big policy implication going forward is how are we to avoid repetition in the next crisis? There will be another crisis. Our government will want to stimulate, give people money. Are we going to have repeated bouts of 10, 15% inflation in every crisis? And for the moment, no one in Washington is owning up to what they did. They could say, look, we hit COVID. That was like a war. We financed it like a war. We spread money all over the place. We held interest rates down. We're kind of proud of the inflation because that made bondholders pay for it, not taxpayers. We hit supply shocks. We hit those with more money so that we wouldn't cause a recession. The inflation was the least of all possible bad outcomes. Yay. We made those hard choices. That's what they did. They made those hard choices. And then we have to say, well, in the next time, do you really want to spend quite so much money? Maybe we need to look at spending a little more wisely. Maybe you want to make better promises about paying the debt off. Facing what we did last time and the hard choices and getting ready to make different choices next time is the only way we're going to avoid it. The Fed thinks all we have to do is sand off the adjectives on the flexible average inflation target. Where there was a moderately, we'll put a substantially, and that's going to do the trick. They're not facing 2% target, 10% inflation. Something went dramatically wrong, or we made a hard choice and we're proud of it, but just face what happened.
Yeah, I agree wholeheartedly with that.
You used to work at the Fed.
But, so here's the thing. Fiscal policy or elected representatives are either going to heed your advice, they're going to become responsible, they'll make the proper contingency plans, and they'll own up to the hard choices that they made, or not.
Or possibly not.
Right. And in either case, you're Jerome Powell, and you've got to decide the interest rate policy in the context of facing either one of these types of administrations. Let's take the one that's not likely to change. What is the role of a central bank in the context of the fiscal theory of the price level? It almost sounds like the theory saying, listen, central banking small potatoes. It's really fiscal. Or is there more? Is there something more to it?
So in the fiscal theory, the central bank remains powerful. Not as powerful as everyone else thinks. Milton Friedman kind of won the debate. We have to recognize, maybe a little too much. People used to think central banks meant nothing at all. He said they completely control inflation. Maybe not quite. So in a fiscal event like we had, there will be inflation. But the central bank can decide how quickly, how much. It can make sooner, make it later. It can do a lot to offset inflation. And even in fiscal theory, over the long run, the central bank does set where the inflation rate is going to be. So they have a lot of power there. And they can fight hard against the fiscal pressures. Our Fed didn't fight real hard. It gave the Treasury $3 trillion of new money to hand out, which it could have not done. It could have raised interest rates promptly if it had wanted to. So if the Fed is not proud of what they did, they should definitely get ready to raise interest rates faster next time around, to fight rather than go along with a fiscal largesse. And they are still on this view that there's a glide path that's going to happen. I view inflation like cockroaches. Just because you're down to the last 1% of cockroaches doesn't mean that the problem's over. You got to nail the last cockroach before you're done. So
I know that story. But listen, I said, suppose that the fiscal authority becomes...
Oh, yeah.
They're just going to continue to...
I didn't answer your question, did I? Go ahead. Yeah,
suppose you said that perhaps the next time Jerome Powell's going to, or the Fed chair is going to raise interest rates aggressively. But doesn't that assume that the fiscal authority at some point will behave responsibly? I mean, my question was, suppose that the fiscal authority is not expected to. There's a new administration, a new way of thinking. Then what should?
Nobody in Washington is particularly on to let's pay down the debt and get ourselves going. So lots of people, not just fiscal theorists, worry about our fiscal situation, our long-run fiscal situation. It is a long-run problem, which is why it's easy to put it off. Where I really worry about it is it denies us the fiscal space to adapt to the next crisis. Not so much that things will go wrong on their own, but that when the next crisis happens, our government wants to borrow a lot of money. Markets are going to say, well, how are you going to pay that back, buddy? And didn't you just take a 15% haircut on all of us last time? So that's where I really worry about it. I have faith that our America will do the right thing after we've done everything else.
You don't want to answer my question, John. I mean, you don't. I am asking you. You're Jay Powell. These deficits, the CBO is projecting deficits up the wazoo here.
Yes.
Are you going to raise interest rates against that?
If I'm Jay Powell, I'm going, yes.
Okay.
Because you said my mandate's inflation. I can do inflation. And I'm going to start talking a little louder about the fiscal problem. Now, this is a political question, and I don't want to criticize Jay Powell. He's taken the view that we don't talk about fiscal policy. That's their problem. We do what we can. But fiscal and monetary policy have to act together to stop inflation should it break out again. And the Fed was pretty good about talking about we need more fiscal stimulus back in those times. So it shouldn't feel that bad about saying we need a little less fiscal stimulus now. But it is true. Both fiscal and monetary policy have to work together to contain inflation. So it's time to talk about it.
I was going to ask about, I do talk to still my former colleagues at the Fed, and I do ask, why don't you speak a bit more about the fiscal situation? And you're right, central bankers really do not want to speak about it. But what do you think? My view is you can speak on it, but without passing a judgment on whether it's good or bad. Just say what you're doing is going to lead to, let's say, inflationary pressure. That's fine, but that's what you're doing. That could potentially mitigate the political backlash, or do you think they?
Well, you're getting into the politics of being a central bank. Yeah. Let's talk about the economics.
Okay.
The economics of it is our institutions have to work together to have fiscal and monetary policy that will contain inflation. And if that means central bankers being willing to talk about fiscal policy, that's one way to do it.
Well, Paul Volcker was famous for going on the Wall Street Journal and writing scathing remarks about Treasury Secretary Donald Reagan, I believe, at the time. And so there's a precedent for it.
The good thing that fiscal theory, again, points out is it is not important to get this year's budget deal or to get the usual accounting gimmicks or to get the deficit down a bit this year or next year. What matters is America's ability to pay off debt slowly, reliably over decades. And that's the only thing that matters. I mean, even out of the 10-year budget window, do markets have the faith that when we sell them more debt, over 20 years, we will slowly be able to pay it back? So that's about solving this long-run budget question, which is very different from the usual more fiscal stimulus, less fiscal stimulus, change this proportion, depreciate that or other on the tax code that goes on in Washington.
Thank you so much, John. That's just common sense as always. This is from the grumpy economist. I figured out why you called it grumpy, by the way. It's because you offer such common sense, advice that is regularly ignored by administrations of every stripe.
Well, thank you. And yes, being ignored makes us all grumpy, doesn't it?
Thank you so much.